Welcome, everyone. Thank you for joining us for today's Portfolio Manager Insights Series webinar highlighting the Barron Opportunity Fund and the Barron High Growth Strategy with Portfolio Manager Mike Lippert. My name is Bill Zorovich, and I'm a member of the intermediary sales team. Just a little housekeeping before we start. If you have any questions during the presentation, please type them into the control panel, the question box in the control panel. And I'll try to bring them up throughout the presentation. Also, we're going to limit this to approximately 30 minutes today. Also, so if you want to also email us the questions, if I didn't get a chance to ask them, you can email those questions to questions@barronfunds.com. I'm going to try to get to as many as possible. Let me start out with Mike is the portfolio manager of the Barron Opportunity Fund and the Barron High Growth Strategy. He is also the head of technology research at Barron Capital. He has 22 years of investment experience and research experience. For the last 17 years, he's been the portfolio manager of the Barron Opportunity Fund. Both the fund and the strategy invest primarily in high growth businesses of any market capitalization, benefiting from innovation through development of pioneering, transformative, and technologically advanced products and services. Without any further ado, I'd like to welcome Mike. Welcome, Mike, and thanks for joining us today.
Thank you, Bill. That was a great lead-in.
Yes, thanks. So let me start out with, you and I've talked a little about this, and we've always, we always talk a lot about process. And the first thing that people ask us whenever we talk about Barron funds, and the first words out of our mouth is always, we talk about we're long-term investors. We have a long-term mandate to investing. Low turnover. You sometimes go a little further and say in your strategies you're going to be faster for longer type companies. One of the things I heard from one of our colleagues, which I thought was a great answer, was he said, and we don't miss recoveries and we don't miss rebounds because we're in the market. And I loved what Andrew Peck, who's portfolio manager, but also our co-CIO, said. It's not like you're going to see all the data and it's going to be okay. Time to put money in the market. We're not going to see Chairman Powell jump up in front of all of us and say it's time to get money in. When I started preparing for this, I started looking through, as I do all the time anyway, looking through the quarterly numbers, which are up 17.96 for the quarter. I started going back and I saw that you're 400 basis points higher than the Russell 3000 growth. You're 1,000 points higher than the S&P 500. And this is just for the quarter, and it's the year-to-date number at the end of the quarter. Stark contrast to what we had last year, right? Maybe you could take us through what we saw last quarter. We're not calling it a recovery, we never have, but things are going better than everyone would have expected. We could take some time to take us through it.
Yeah, let me take these on in two parts. And the first one I think is long-term investing and what some call market timing. And I've written about it. Of course, Ron Barron has written about it for so many years. You'll hear even luminaries like Warren Buffett write about it. Recently interviewed on CNBC to talk about, market timing, how almost everybody is wrong. You're only good at it in 2020 hindsight. And since we don't have a time machine, you can't go back. So we stay invested, and we stay invested in the approach that we believe will benefit our shareholders for the long term. And for me, that is, of course, long-term investing, but it's investing in these big secular growth themes or trends that are driving industry forward. You've heard me use lines like, it's the growth stupid. Yes, Mike, faster for longer. Because I think when you think about the market at its simplest level, you have PE, which goes up and down with market sentiment, and you have the E, earnings. It could also be free cash flow. And that E only goes up with growth. Long-term growth, and usually that's driven by the top line growth. So, and when we look just historically at the best companies, the best investments historically, Alphabet, Google, or Microsoft, or Amazon as a few, NVIDIA, these are companies that have grown faster for longer. They've benefited from or have driven important secular growth trends. They've gone from being a one-product company to multi-product companies. We call it second or third acts. And some of them have gotten to the level of truly becoming, a platform for their users and their customers. And I remember you and I talked when we were preparing for this, how in 08 and 09, you know, the market bottomed in March of '09, and like later in the fall, we're doing marketing, and people were asking, did I miss it? Did I miss it? And certainly the next 10 years showed, no, they didn't. But market timing is very hard. So when it comes to the first quarter, the fund was up, you know, approximately 18%. There was absolutely a rebound in certain industries that underperformed last year, which I did talk about in my last quarterly letter, saying, I don't know the timing, but I believe things look very promising because of the secular growth trends, the strength, even though we have the overlay of a cyclical market and certainly the ups and downs of multiples dealing with what the Fed's going to do, where the 10-year and 2-year are going to be, all things out of, you know, our control at Barron. And I said it looked very good for the themes and trends and industries that we accentuate, like electric vehicles, like cloud computing, like software as a service, and a newer one for us, which we built on last year, semiconductors. Those areas led the portfolio in the first quarter. Some of our top performers were, you know, Tesla electric vehicles, Microsoft and Amazon, certainly cloud computing companies, and semiconductor companies, whether it's NVIDIA, Indie Semiconductor, AMD, were ones that led the portfolio. Because I think in a very tough macro that became more and more apparent, and the recession is now widely accepted by the street, and we could talk about the uncertainties. I think nobody knows whether it will be long and deep or short and shallow. Investors went back to ones that, you know, had greater long-term growth, would have more resilience against a weak macro because of these secular trends, and certainly ones that they thought would be the first ones to either rebound or accelerate when the economy recovers.
We've talked about this, and we want to get it out there. We're trying to limit to 30 minutes, and it's a huge topic. You mentioned NVIDIA, you mentioned Microsoft and Bill Gates, and you also, in your letter, which I implore everybody to read, it's and go back and you can look at other letters too. They're great. But you put some quotes in from the CEO of NVIDIA and also Bill Gates about ChatGPT and AI. I mean, it's tremendous, and you've actually had some investments or taken some money out of investments, and I tell people, let us do it for you, because it's complicated, but it's out there. But it is you know, Bill Gates said it's transformative, and this is big, and so did the CEO of NVIDIA. And maybe you can comment on that and comment on those two. You know,
yeah. So in the last couple of quarterly letters, I have written pretty extensively on artificial intelligence, AI, and I urge everybody to read those sections, because we could run a whole half an hour on it today. We're doing an incredible amount of deep research on this topic. We've been investors in AI for a long time. Every quarter I put themes in, and you can go back years that we've talked about AI. Initially, AI touched most people with what they call recommendation engines. So you could think about it when you're on Amazon, what products they show you to buy. When you're on Netflix, you know, what movie to watch. Certainly Spotify, what song you might like next. Those are recommendation systems. Generative AI, large language models that we exploded on the scene with ChatGPT in November, is a different form of artificial intelligence, and we believe is a real inflection point. It's a real turning point. Certainly Bill Gates talked about that. People can look at the quarterly letter, and I have some quotes from Jensen Huang. He talks about this as the quote unquote iPhone moment. This is as big, as most significant shift as, you know, the shift to the internet and then to the mobile internet, where we all walked around with a computer in our hand. And we believe that. And we see so many industries that will either be disrupted and or major beneficiaries of this. And early in our research, one of the really important things is to know what the right questions to ask. For example, where does the true value and differentiation lie in artificial intelligence? Is it the model itself? Is it what you might think of as the prompt or the user interface, or what we call intelligent APIs that might allow you to tap into different models? Is it the data, whether that data is your own public data from surfing the internet, or your customer data that you are storing for them and you can utilize? And so we're asking all these questions. It's quite clear to us that companies like Microsoft, for example, which has an investment in OpenAI and has now showcased some of the ways that they could bring AI to Bing search to compete with Google, and to a lot of their Office products. Certainly, NVIDIA is a full platform company now in terms of AI, with not only the chips, but the cloud services, what they call foundational models, libraries, a whole number of different service offerings. And we've also looked at the ones that we think can be challenged. And I know we have a question from one of our shareholders on Google. So why don't you answer that question, and then I'll answer it for you.
Sure. And the question came in from one of our shareholders and one of our financial advisor. What was your rationale about reducing by 56% your position in Alphabet over the first quarter?
Yeah, so Alphabet, of course, for everybody, is now the name of the company that owns Google. They also own YouTube and Waymo and other things, but it's really Google. And you have to, as an analyst, you have to react to what you know, what you don't know, what you can't know. In all of what we do here, we try to understand big trends, whether a company has a competitive advantage, how sustainable is that competitive advantage, what's the likelihood of disruption. And when we really saw ChatGPT, we saw how quickly it took off. We saw all the attention it got. I think now there's reports of 300 million users. And we thought about the use case, a very general information assistant use case. It's going to be very competitive with search. We've seen what Microsoft has showcased with Bing. We've talked to Google. They've talked very publicly about how they're going to change their own search. And when you think about it, it's definitely a risk to Google. We don't know exactly how that will play out right now, but we know that it's a big risk. And, Microsoft, for example, has almost no market share in search, so it's a positive for them. Where Google, outside of China, the market share is something, round numbers, 90%. It is highly monetized with the so-called 3 or 5 blue links that we click on and go to a website when we do a Google search. Just think about it. If the way we access information, entertainment, products and services change, we have a chat-based assistant that will give us the answer. Maybe it'll be Google, maybe it'll be ChatGPT, maybe it'll be some other. Maybe there will be ones that'll be more domain specific. I go to one for travel and one for food and one for home. And then the monetization, we're so early on that we don't know, that we thought for a company that was making, had 90% market share, highly monetized, this was a substantial risk. And at this juncture, we don't know what the answers are. We decided to take Google down in the portfolio. It is below the index weight that we compare against the Russell 3000, but we decided to maintain a position because Google has incredible assets in that they will go against AI. They have been one of the leaders in the science of AI. And when you think about proprietary data, they have 20 plus years of search data, YouTube data, using Gmail, and right now OpenAI and ChatGPT has been built on public data. So Google has certain advantages. So we decided the appropriate thing was to take Google down and make it what we believe is an appropriate position during this uncertain period. And we are researching this area very, very hard.
Looking at a couple of other holdings and positions that you've taken down and added to in the EV side of the house, Rivian and Tesla, maybe you can make some comments on what you did there.
Over the last 2 quarters, particularly with Tesla trading down, which it did, last year, and then early first quarter, it ended up being a top contributor for us as the stock rebounded. But we took advantage of that opportunity to increase our position in Tesla. And I've written about it extensively. I'm more than happy to summarize. I think people pretty well know our views. The new thing that happened this quarter was they had an analyst day. I talk about that in our quarterly letter. And we got to drive in the Cybertruck. We got to tour the plant. They showcased the bench talent around Elon. And we came out thinking they were literally just playing a different game. We are very positive on Rivian and their management team and the long term. We were private investors. We sold down some of our shares and kept some of our private shares at a very attractive level. But Rivian faced a little bit of a perfect storm, not only when they went public, but when they came to the market, where their production was really limited, not by themselves, but by the availability of semiconductor chips. Their costs went up significantly with global inflation that we had. Because they had 70, 80,000 reservations, they actually tried to raise prices on their reservation holders. We thought that was a mistake. They realized that was a mistake and they changed that. But because of all of these changes from when we first invested as a private company, they're going to have multiple years of actually burning cash. They went public with $20 billion, but they're burning a substantial amount of it. They just recently raised some capital. We do believe that we're going to need to raise more capital. So the risks associated with Rivian went up significantly, even though we don't think the reward has changed. And when Tesla traded down, we thought the risk-reward balance in Tesla and where they are in their leadership was just better positioned than Rivian. So we keep holding Rivian, but we move some of the dollars from Rivian to Tesla, Bill.
When you look at your themes that you're investing in, I know you're excited about ChatGPT and artificial intelligence. You have a lot of excitement about the EV market. What other themes? Maybe you can, in your point, you talked about it in your letter and you pointed out some of the stocks inside. What other themes? What makes you the most excited in your portfolio?
I tried to talk about in the last couple of quarter letters also, and it is semiconductors. I would say for many, many years, we were underweight semiconductors. Historically, it's proven to be a very, very cyclical industry. And I won't lie to anyone, there's still a cyclical overtone. But we think, and I think this is pretty consensus now, but the secular drivers in semiconductors are much more substantial than they used to be. It's all things that we've talked about, Bill. Artificial intelligence is built on semiconductor chips. Cloud computing built on semiconductor chips. The digital world we live in, semiconductor chips. Cars now, as they go electric and certainly autonomous driving, infotainment systems have much more semiconductor chips in them than they used to have. The so-called world of IoT, the Internet of Things, all the devices that we have in our houses. For example, if you have a Nest thermostat, it has a semiconductor chip. So I wrote about this. When we think of the secular drivers, the demand for semiconductor chips, I wrote, is literally as long as our research eyes can see. And so we leaned into some of the big themes with our semiconductor investments. We've had a long-term investment in NVIDIA. It is now, I believe, the second largest investment in the portfolio, not only driven by cloud computing and data center computing, but now a leader in AI. And I discussed that in depth in the quarterly letter. A company that's benefiting from what's happening in the automotive space, a small cap company, kind of the Barron heritage, is Indie Semiconductor, and that was also a leader for us. And so we've really taken this industry up in our portfolio as it's benefiting from a lot of the themes that we've invested in for many, many years. And last year, when the stocks traded down to very low levels, we built that portion of the portfolio up substantially, and it definitely benefited us in the first quarter, and my belief is that it will benefit us for many, many years to come.
We've got a question I want to, we're known for buying stocks at the right price, and everyone looks at us as a growth manager, as a firm, and your fund is really a high growth fund. The question that came in a high growth area, how do you generally put a value on the company's growth versus what you will pay for growth?
So we do a lot of detailed work. One thing is, we look at history. We don't think that the world will change. Multiples do go up and down. So we do a lot of work looking at different sectors or different industries, how they have traded over time in different environments, whether they're different economic environments, different interest rate environments, different growth environments, different margin environments. For example, software in its early days, very few companies had achieved significant margins, so people didn't know what those companies would look like. And a revenue multiple is kind of a shorthand for what the ultimate profit or free cash flow multiple. So we do a lot of studies. And I've written about this a lot in the quarterly letters. Our goal is to use multiples in our long-term valuation work that we believe are average or median multiples for a business of that type. And of course, we have to select multiples or ranges of multiples for each individual company. And that part of that is, of course, all of our qualitative and quantitative research at Barron. So we prepare at least a 5-year model on every single business that we're going to invest in. the full model with the revenues, the P&L, the cash flow, and we can see growth rates, we can see margins. Then of course we have all of our qualitative research, and what is your conviction or confidence level in a model? Any model is a projection. It is going to be wrong. How wrong is it going to be? What's our confidence level in all of these qualitative factors? What's the growth opportunity? The product market fit that they have, the competitive advantage, the management team, aspects of the business model. And we're ultimately making judgments on what we think is an appropriate multiple for a company of that type. And what I do is I run it out for 5 years. And so I have short-term price targets, long-term price targets. We also run downside cases, whether the downside case could be the multiple falling. And of course, we could run downside cases on fundamentals. So the revenues, earnings, and cash flow not hitting our levels. And then at the end of the day, the position size takes all of this work and research and analysis. And then, me as the portfolio manager with the support of the analyst are making a judgment call. How big a position should NVIDIA be as, a proven winner type company? How big a position should an indie semiconductor be as a small company that's kind of, a challenger or an emerging business? And that's how we do the work. So we use history and we use analysis to try to not to find new normal multiples. And when I talked about last year, given where stocks traded down to, we were able to value companies and get substantial returns, 15, 20 plus returns, where I believed we were using multiples that were below the long-term median or average, which meant, okay, when the world returned to some normal, and I can't predict interest rates, so I don't know what they'll be, that, maybe we have the opportunity to take multiples up. But here we could be conservative on our estimates, conservative on our multiples, and still see very positive long-term returns.
So, Mike, we normally do these calls when we usually do them a little later in the month, and we have a lot of times when I do this call, you'd like getting ready to jump on a call with a company for an earnings call for a company. In the first quarter, we had companies issuing guidance, and what are you expecting to hear from companies this quarter as they come out? Generally, what are you seeing has been happening through all the research you've been doing, getting ready for the calls and whatnot?
Yeah, I think most businesses today are trying to achieve a balance with their own customers, whether they're consumers or business customers, between the uncertainty of the macro environment, the demand for their particular products and services. And so we're certainly leaning into right now products and services that we think will be more resilient in an uncertain market, and these longer term trends, and getting their customers to be focused on the long-term trends that are involved, because you don't know exactly when the economy will bottom. But most good companies want to get stronger. Of course, some small companies, venture companies, have to protect themselves. Most companies want to get stronger during a weak environment, and therefore you can't fall behind your competitors in terms of product and services, buying software, building out cloud computing, investing in artificial intelligence. So we think during earnings season, we're going to hear a lot of balance between the current, whatever somewhat challenging macro and the long term. And certainly there will be some companies that will prove absolutely more resilient given where they're positioned with their product and services. And there will be other companies that are facing bigger challenges because they're a little bit more macro sensitive than others. So that's what I expect. Yeah.
Got it. When I'm going to go back to earnings, and you talked about last year we had a lot of compression, multiple compression, and there was a huge disconnect from what we're hearing from the companies and what the stock price seems to be changing. Seems to be getting back more to normal.
Well, I mean, it changed some. Anytime you have the market just moving up over a short period of time, measured by one quarter. We're not far enough into the year that quote unquote numbers have changed that much. So company guidance hasn't really changed yet. We'll see with the first quarter. Wall Street numbers, our numbers, sell side numbers haven't changed much. So that the fact that the fund was up 18% and some of these industries were up, you got a little bit of multiple expansion. So we're back in the very, very short term to multiples that are more in the range of normal. But when we look long term, I want to be very, very clear. When we look long term with the exact same way that I described just a moment ago, with reasonably conservative multiples and reasonably conservative models, which is where we are right now, we still see, double-digit returns for the companies, that we're investing in. So that hasn't changed. And when it comes to, market timing, I wrote about it last quarter. I felt we were at a very favorable level for the portfolio, but I never would have, ever told people what I thought, a given one quarter would be. And just to be clear to everyone, the fact that we had an 18% move, I don't think that's it, right? Just like in '09, Bill, as we started this call, when we got to the end of '09, I didn't think that was the end of the move. Again, the principal thing that we're doing at Barron and with the Opportunity Fund and High Growth Strategy is investing in these really powerful long-term growth themes and businesses and industries that will grow faster for longer. And we think there's quite an ability in our portfolio, given how we're modeling now and how we see Wall Street modeling, that for these key trends, cloud computing, artificial intelligence, electric vehicles, numbers are going to be going up, not down, and that will support stock prices, over the long term.
Got it. So, Mike, we're ending up on the 30-minute point. Here's what I'm gonna, as a call to action, I'm gonna implore everyone to do. I know a lot of people look through the first quarter, you look at funds, and you kind of set your menus up. I'm gonna implore everybody to go back in and look on our website. Our numbers are all on our website. And look at the performance and revisit the Opportunity Fund and look at the numbers, because it's telling a story of recovery, and things are happening where you should be revisiting. Don't just focus on, oh, I did it in the first quarter. Let me come back and revisit it, as I did when, preparing for the call, as we all do all the time when we prepare to go out and talk about our products. So call to action is revisit it. Take a look at it. Let us be the ones who, these are exciting. The companies you're investing in, they're exciting ones. There's some the large cap ones that have been around for a long time, but there's also some small companies that are coming out of nowhere. We have privates in it with something like a SpaceX. Revisit it. If I can really ask you to do that. So let's finish there. Let me just take a couple seconds to thank you. This concludes our recording. I'm going to comment one quickie, because no one's getting driven more nuts than me by the Barron being backwards on there. We'll fix that for next time. I didn't want to do it during the middle of the presentation in my background. But this concludes today's investment series call. A recording of today's events will be available on our website at barronfunds.com. I want to thank you, Mike, for your comments as well as joining us today. Most importantly, I want to thank everybody for joining us, and I want to thank you for your continued support in Barron Funds. Thank you. Thank you very much, Mike.